There we are. Good morning, everybody. Welcome to the local pension board. First item on the agenda is the election of chair for 2020-2021 municipal year. Can I have nominations, please?
Chair, I'd like to propose Ian Guy as the chair.
Okay, can I have a seconder for that?
I'll second that, Chair.
Okay, all in favour?
Yep.
Yes.
Okay, everybody happy with that? Agreed. So, Ian Guy. Ian, the chair's yours. Thank you.
Well, thank you very much for your show of faith in me. That does mean that we're departing from our terms of reference, because normally the chair alternates between the employee side. So before that's confirmed, perhaps the board could get legal advice from our esteemed legal advisor.
Yeah, I can confirm in the pension regulations it isn't mandatory to have a rotating chair, so you agree terms of reference locally. So if there are particular circumstances to depart, as long as the board agrees, you can do that legally.
So we'd need a subsidiary resolution, would we, that we are consciously departing?
I've proposed that you were going to depart from your terms of reference, and then the board vote on it, and then it's confirmed then in the minutes.
Okay, so could we have a vote on that as well? Jeremy, did you want us to go around, or is indicating sufficient?
With the low numbers here, I think indicating is sufficient here. You could do it on the hands up if you wish.
Okay, so I suppose technically this departure should come before the chair's vote, but a vote on departing from our terms of reference to allow that?
Yeah. Okay, that's all in favour.
Well, thank you very much for your show of faith in me as chair, and welcome to this meeting, which, as you know, is being recorded. Next item on the agenda is the election of vice chair, and could I have any nominations for vice chair, please?
Chair, I'd like to nominate Councillor David White.
Thank you very much. And any seconder?
Can I just say I'm not a councillor? Although I am a councillor in another role, I'm not a councillor in this role.
I will second David White.
Thank you. Any other nominations? No. So I suppose we ought to technically have a vote to confirm David. All those in favour? And against? And I see no against or dissenters. Thank you very much. Normally we'd go on to apologies for absence. I don't think there are any, are there?
No apologies, Chair.
And disclosure of interests. How do you want to deal with that, Jeremy? Will you be going circulating your usual form, or do you want us to formally declare?
Yeah, everybody formally declare, and then I'll circulate the forms after the meeting.
Okay. My screen is doubtless in a different order to yours. Do you want to go around announcing our names and recording our declarations, Jeremy?
Yes, please. Yes, please.
So, do you want to call our names? Because my screen's
Right.
going to be in a different order to yours.
Right. Okay. Councillor Peter Jones.
Well, I'm not a member of the local government pension scheme. I am retired. I'm a member of the university superannuation scheme, which is different. So I don't have any personal interest of that kind.
Okay. Thank you. Councillor Alan Lockyer.
Yes, I am a member of the pension scheme, as is my wife and my son.
Thank you, Alan. Rosemary Broad.
I'm not a member of the pension scheme, but I do have a sister that works for Neath Talbot County Borough Council, who is a member of the pension scheme.
Okay, thank you. Ian Guy.
Yes, I'd like to declare in relation to all the agenda items, I'm a member of the scheme and indeed the Swansea Fund.
David White.
As with the chair, I'm a member of the scheme And I have a few colleagues and friends who are also members of the scheme as well.
Thank you. And officers, Stephanie Williams.
Yes, Stephanie Williams. I'm a member of the local government pension scheme, so I'd like to declare.
Karen Cobb.
I'm a member of the local government's pension scheme.
Jeff Dong.
Whole agenda, member of the LGPS.
And I'm a member of the scheme as well. Okay, thank you.
Thank you very much. You'll see the next item on the agenda are the minutes of the previous meeting, but with the board's agreement, I'd like to rejig the agenda slightly to bring item 11 forward. I'd like to welcome David Morton to the meeting, who will be talking about our investment strategy. And after David's done his piece, he can either stay or he can go and get on with the rest of his day. Is that acceptable to the board?
Yes.
Yes.
Thank you very much. Well, over to you then, David.
Sorry, Chairman, just before David starts, could I just give the board, just by way of introduction to David? Is that okay, Chairman?
Absolutely.
Just before David launches into his presentation, as a matter of you know, it's a staple in the diary of the pension fund. We hold an annual consultative meeting with all our employers in the scheme, and associated bodies are invited, unions, employers, other stakeholders, etc. And obviously this year that meeting was held remotely. All members of the board were invited, and David made this presentation at that meeting, and that was earlier this month. The presentation itself was very well received, and I know a lot of you, because of your other commitments, could not attend the ACM. We felt it very useful if you had the opportunity to hear that presentation again today from David. So I asked David along to make that presentation again, because of its pertinence and relevance to where we are today, and his commentary on the markets and the effects of the very real events that we're all experiencing on the pension fund now. So over to you, David. Thanks, Chairman.
Thank you, Jeff.
Thanks, Jeff.
It's very nice to meet you all. I'll share my screen so that you can hopefully see the slides. Technology willing, that should hopefully be coming through on your screen now.
Yep, all good. Thanks, David. We can all see that.
Excellent. Okay, so I'm just going to have a brief run through of what's been happening in markets, and also provide you with an update on a lot of good work which has been done with the fund's assets, and then finish off by looking ahead to the next 12 months and beyond. So, quick snapshot, first of all, of how this scheme's assets have been performing, and it's good news really across the board, looking at both shorter term and also more medium term performance. The fund's assets have been outperforming the benchmark, and the overall returns you'll see on the right hand side there, a little over 4% per annum, broadly in line with the returns which are assumed in the funding valuation. So essentially assets keeping pace with the expected returns built into which is done every 3 years. This nice smooth picture belies a lot of the volatility which has been happening in markets behind the scenes. It'll probably come as no surprise to you that there was that big bump in markets earlier in this year through the outbreak of the COVID pandemic. And we saw some markets, equities in particular, fall 35, 40%. So it's been a pretty bumpy ride throughout the period. We have seen quite a strong recovery in markets. Equity markets, you might have seen in the press that the Dow Jones touched 30,000, which is the highest it's ever been just a couple of days ago, which does seem slightly odd that while there's been some good news, vaccine announcements, it does feel that there's quite a lot of uncertainty still in markets. So it's a little odd to my way of thinking that they have recovered quite as strongly as they have. The other thing which has been a bit odd over this period is that equity markets, which tend to respond to economic conditions doing well when the economies are doing well, have been moving pretty much in the same direction as gilts, which you would normally expect to move in the opposite direction and provide protection when markets are falling. You see from the bump in March that everything fell around the same time, and then since then markets have recovered pretty much across the board. You can see a spread here with the least risky assets, the gilts, falling a bit less, and the most risky assets, equities, falling more. And that's a pattern that's been recorded in most markets. Although equities themselves have been very volatile, if you look below the surface at what's been happening, there's even more divergence between various different sectors and types of investing. So on the left-hand side here, you can see growth equities, which include the big technology companies, the Amazons, the Facebooks, the Netflix of the world, have actually done really well, where a lot of the more traditional businesses, for example, some oil firms in the value sector, performing pretty poorly, and as much as 40% difference between some of the companies in those sectors. So depending on how you've been invested, it can have a really big difference on your returns. You can see that by sector on the right-hand side chart, where again, looking at technology at the top and oil and gas at the bottom, where really big differences in that outcome. So although equity markets have generally been going up, not everything has been buoyed at the same time, and it has really mattered which sectors and which type of stocks you've been invested in. We've seen that picture change a little bit since the announcement of the vaccine. Some of the technology companies which have benefited from the growth of working at home, etc., have seen a bit of a paring back in their stock prices, and some of the more traditional businesses seeing a bit of a bounce. So this picture sort of starting to converge a little bit more recently, but still a lot of difference and a lot of volatility out there. If we look at the more defensive side of things, so this is looking at government bonds, whether that's in the US, the UK or Germany, tends to be the big three that get used as examples. You can see that across the board, gilt yields have moved lower. Now that is really suggesting that investors are expecting interest rates to be a bit lower for longer, perhaps because they're expecting a bit of a recovery, bit of time to be taken for the recovery. And the big difference in the US, in America, they had started raising interest rates in recent years, finally coming out of the 2008-9 financial crash, but those have now been pared back more or less to zero again. So I'm kind of right back where we were. If we look briefly at how did the recovery compare to previous falls in the stock market, you may be able to pick out there's a brown line at the very far left, which spikes downwards to about 65%. That's what happened in March this year. And then there's been a very rapid recovery back up within about 6 months, equity markets as high as they were before the crash. That is one of the fastest recoveries that we've ever seen. And if you compare that to the tech bubble bursting, or the great financial crash of 2007, you'll see those taking many years to recover. I think that's a reflection of just how much stimulus has been provided in the form of rock bottom interest rates from central banks, huge amounts of liquidity being pumped in from quantitative easing, and also government spending, whether that's on furlough schemes or other investments. So really a huge amount of cash being added into the system. And there has to be some worry that that is what's leading to the growth in the asset prices. So that stock market recovering back to all-time highs, not fully a reflection of investors expecting profits from companies necessarily. That could just be that there's just a lot of demand from all the cash which is in the system these days. which perhaps leads on to some concerns about what might happen with inflation down the line. No signs that there's any huge tick up in inflation at the moment. We're keeping a close eye on in terms of portfolios. There's been lots of talk in the press about different letters used for the shape of a recovery, whether that's V shape or U shape or L shapes. Very much a V shape that we've seen so far, a rapid fall followed by a very rapid bounce. I think it remains to be seen just how things progress from here. Clearly very good news around all the vaccines being announced, but a lot of economies still very much in lockdown. Some companies suffering very badly, reduced earnings, and it's possible that we may see a setback from here. So it's still quite a lot of uncertainty in markets, I would say. While there's rightly been a lot of focus on COVID and the impact that that has on individuals as well as businesses, there's a range of other events carrying on, which again sort of lead to questions around the levels of markets. So you'll no doubt be aware that there's been rising tensions between US and China, particularly with Trump at the helm, and it remains to be seen how that evolves with the change of president in the US. So far, the stock market seems to have reacted fairly well to the US election results. Again, markets all-time highs. So we'll sort of keep an eye on that and see how it evolves from here. Closer to home, the Brexit is still sitting on a knife edge. We're hopefully edging closer to a deal, but that doesn't seem to be totally over the line yet either. And we're getting down to the very last days. So again, some uncertainty there. And then in the background, the kind of ever-present challenges around climate change and the effect that will have on individuals and economies, and potentially huge changes in investment and spending patterns, which will lead to some companies doing much better and perhaps some companies doing much worse in future. So lots of considerations happening behind the scenes. So far, stock markets taking these all in stride and performing well, but a lot of risk still remains in the system. So turning now to your own fund and how we've been thinking about the investment structure and making sure that you have a balanced and well-diversified portfolio. The way that we tend to think about this is to break investments into three main areas. So we'll look at growth assets, which are expected to generate the bulk of your returns. Those tend to be the most risky assets, like equities and private equity, which do very well when economies are strong, but can suffer in downturns. We then have a more stabilising section of assets in what we call the income area. These are assets where a lot of the return is expected to come from contractual cash flows. So those might be corporate bonds or other assets which generate income like infrastructure, etc. Those are in there to provide a bit of balance and a regular flow of cash, which is really helpful for paying benefits, particularly as the fund matures and you get a growth in the number of pensioners that you have and the number of pensions increases. And then finally, we have the protection area, which is investments like corporate bonds and government bonds, which are expected to be less volatile and should hold up better if there's any problems in markets. And that gives you a place to fund benefits from during periods when markets are down. The journey that you've been on, and we expect you to continue on, is a gradual moving away from the growth assets into more income and protection assets as the fund matures. At the moment, around 30% of your membership are pensioners, so you're still quite a young scheme by comparison to quite a number in the UK, and therefore you can afford to have the majority of your assets invested in growth and higher risk investments. But as that changes over time and as the number of pensioners increases, we would suggest that you have more income and a bit more protection in the portfolio to make sure that you're able to pay those without any problems. This is going to be a gradual evolution. Some steps have been taken along this journey already. and we expect that to continue in the years ahead. Over the last 12 months or so, the fund has made commitments to a range of new investments, covering residential housing, infrastructure, renewable infrastructure, and more income assets, which provide higher levels of yield. That's around 200 million, which has been committed to these assets, which is around 10% of your total fund. And the monies for that will be gradually drawn down over the next 12 to 18 months or so and invested as opportunities come along. In the meantime, there has been protection put in place across the equities. So of that 200 million, which is moving from equities into these areas, a strategy was put in place to protect that in the event of any market turmoils. Now, I would describe this as quite an innovative strategy. I don't see it used very often in local government or private public sector schemes. So this is quite a neat way of making sure that you defend the value of that equities so that you can draw the money down into these assets. And that provided you with a lot of protection in March when we saw equities fall. So that's been a good approach so far. The final area that I wanted to touch on, which has been a big focus for the team and the fund, is around responsible investment. So you have a policy in place for the fund on this, which is intended to increase the focus on carbon-related investments in the fund and thinking about sort of future climate change, etc. And you have quite an advanced policy on this, where you're aiming to reduce your carbon exposures by 50% by 2022, which is the most ambitious target that I've seen, and I think a really good policy to have in place. There's also been a lot of work put in place to move you towards that. In recent years, you've moved into a low carbon investment with BlackRock, which has a big impact on your equity allocation, and also moved into the renewable infrastructure investment, which I mentioned earlier. In addition to that, we're looking at new investments with WPP, which are expected to reduce that exposure even further. But the Swansea Fund in particular was keen to move faster than WPP have been able to do so far. And again, an innovative approach has been used there to put an overlay on top of the equity strategy to remove your exposure to a lot of the carbon emissions, which has brought you down quite close to that 50% target so far. So you're well ahead of your target timescale. And the expectation is that as new investments become available through WPP, those will gradually be adopted by the Swansea Fund, and that extra projection strategy overlay will be removed. So that's been a main area of focus, and we'll probably see more work in that in the next 12 months as part of the ongoing programme. So key areas of focus will be around the drawdowns, and so that 200 million over the next 12 to 18 months needs to be moved from equities into the new investments. We're working with Jeff and others in the team to look at a continuation of that. So recognising that equities have performed very well, does it make sense to trim back some of those allocations now and lock in the gains that you've earned and put that money to work somewhere else, which has got enough return to support your funding valuation? So looking at some options there over the coming months, and then continuing to work with the Welsh pool to take advantage of what they're able to provide and benefit from the economies of scale and hopefully the cost savings which will come through as a result of that. And through all of that, keeping in track of the fund's responsible investment policy to make sure that we're keeping you on the right side of that direction of travel and moving towards and completing that 50% exposure to carbon. So that's been a very quick canter through what's been happening within the fund, how it's responded to market conditions and where we see things going. Very happy to take any questions or comments from this group.
Thank you, David. Board, any questions for David?
I'd like to ask a quick question. You mentioned about the impact on pension funds, and yesterday we saw the spending review. Now, usually it's a 3 or 4 year spending review, but yesterday we had a 1 year spending review, and it's my understanding that was a positive move. So, what are the impacts? I know it's short, early in the day. What do you review yet?
So one of the main impacts of that will be around government borrowing. So there's some interesting things happening in relation to government gilts at the moment. That you may have seen an announcement in the press yesterday that the government is changing the way in which it links inflation-linked bonds to RPI, and they will be linked to CPIH from 2030. So that's been happening, as well as the spending review. And what we have seen is actually an increase in gilt prices as a result of all of that. So despite there being kind of more issuance of gilts, kind of more borrowing happening, there seems to be a lot of pent-up demand from pension schemes and others. So despite that increase in borrowing, gilt yields still seem to be staying quite low.
Oh, cheers, thank you.
Anybody else?
Yes, please, Chair, if I may.
Of course.
A little hand up, but anyway.
I'm testing my eyesight on the screen at the moment.
Sorry about that. A question and a comment, if I may. First of all, the question. I was interested looking at one of the charts earlier on, that UK equities seem not to have been keeping anything like pace with the line for global equities. And I wondered why that was. And then, if I may, a comment. Yes, thank you. It's perhaps David, could you comment on that first, and then I'll make my second point afterwards.
Yeah, so I think there's potentially two reasons for that. One, probably no surprise, around Brexit and the extra risks attached to the UK. Okay. But the other less obvious one, I think, is in relation to the makeup of the index. So if you compare the FTSE 100 with the S&P equity indices, there's a lot of tech in the US. So that's where the Amazons and the Facebooks and the Googles are. And they've seen the vast majority of the returns. A lot of the UK index is the Shells and the BPs and some of the banks make up a big proportion of that. And as I showed in one of the earlier slides, or it might actually be the next slide down, the financials and the oil and gas very much at the bottom, whereas the technology very much at the top. So that, again, it's really mattered what type of stocks you've been buying in the UK market. The big names in the UK market are quite different to what's in other areas.
Okay, well, thank you for that. That explains that. And then my comment, almost by way of a kind of introduction about myself, if I may, as a new member of this board. For many years, I was a member of the Welsh Government's Climate Change Commission, and I previously worked before retirement for the RSPB on sustainable development, climate change policy, energy policy, etc. So I've got a particular interest in the actions that the Swansea Fund has been taking in relation to cutting investment in fossil fuel industries, if you like. So I found the information provided, not in this paper, but in one of the earlier papers, very informative and helpful. And I agree with you, David. It's very impressive. I'm very pleased to see what Swansea are doing in terms of action to cut by 50% by 2022 the fossil fuel commitment. Question, I suppose, following on from that, and I am very much committed. I'm a Green. I'm a member of the RSPB and other organisations. What about going beyond the 50%? I don't know whether that's a question for you or for others or for another place and another time. But I'm wondering, I mean, obviously, ultimately, I appreciate that fossil fuel investments are only a very small part of the overall portfolio. And also, moreover, that local government investments are a very small part of UK, 4%. Nevertheless, in terms of making a statement about getting out of clearly fossil fuel industries linked to climate change. Moving forward, maybe it's not for this board, but clearly just to make an observation that I would hope that we'll be moving beyond 50% after 2022 towards 100% as soon as possible. I don't know whether others want to comment on that. Thanks.
David, I don't know if you've got any
if I may,
contributions you want to
Chairman.
make there, and perhaps Jeff will as well after you.
Yeah, well, if I may, David, because I don't want to put David on the spot to speak on behalf of the committee or the fund. David advises the committee and the fund. However, internally we do have discussions about future aspirations in this regard. Councillor Jones, and you're quite right. I think the report that you refer to does indicate next steps and future considerations, reviewing those targets and how we can continually evolve how we address and tackle climate change as a pension fund. But as you say, when you reference that report, I mean, is it the role of pension funds to be addressing climate change on its own? As you say, it's a very small stakeholder in that regard, and also the targets and aspirations that we set out back in 2017 at the outset of this journey was very much ambitious at that time, as David indicates, but we thought it was reflective of the transition economy, reflective of where we were moving as an economy. Because what we don't want to do is to disadvantage the pension fund economically and financially, making these moves. And so we felt that target at that time was ambitious enough, made a statement and helped influence our colleagues and stakeholders in making similar changes, but did not financially impact on the fund adversely. But as you say, as society catches up, and as you're aware, the take up of electric vehicles, the take up of, that there are stats in regard to the cost of renewable energy now. It's targeted to be cheaper than traditional fuel by 2030. So as that inflection point in the economy and transition actually occurs, we can ramp up those aspirations and targets accordingly. And the chairman of the committee and the committee as a whole is very much engaged in that agenda and that journey, and wants to be at the forefront of that movement and help influence and make change happen elsewhere. I don't know if that accords with David's experiences elsewhere in the LGPS and other pension schemes per se, but I would say anecdotally that Swansea and the LGPS is definitely making great strides in this regard, I would suggest.
Yes, thank you for that answer, Jeff. I mean, I don't want what I'm saying to be taken as criticism of the committee. It isn't. I appreciate very much the progress that is being made. But as you say, we need to look beyond 2022. And I'm sure all of this will be kept under review in the light of developments. Climate change is with us now, and we must act quickly and comprehensively. But thank you very much.
Councillor Jones, I personally welcome what you say. Just on one point, you asked whether it was a matter for the board. There was a day set aside which the board members participated in, which led to the formulation of the responsible investment policy. And I know that those members of the board who participated in that day found it very valuable. Mm-hmm. And that leads me on to perhaps a question for Jeff rather than David. Jeff, when is that policy due for review?
Good question. It's as you're aware, it was slightly tweaked and evolved to incorporate WPP issues, etc. So it's a live document, I would suggest. I suppose a good time to review it is as we approach 2022. When that target date was originally set? Because as indicated in the report referred to by Councillor Jones, we're almost there anyway now at 47%. So it may be a good idea to reset that in the next 12, 18 months or so. Anyway,
I'd welcome that. I think probably 12 months. But towards the end of that, given the time it's going to take to set up, I think you participated in the RI Day, didn't you, Jeff? And
yes. Yeah.
I found it one of the most rewarding things that we've done as a board and indeed as a committee working together. I'm seeing 4 hands up, but my screen doesn't tell me who's got their hands up, and some of them may be stale anyway.
Councillor Lockyer has got his hand up.
Councillor Lockyer.
Yeah, thanks, Chair. Yeah, I mean, I think actually Jeff is quite more than eloquently put over most of the points I was going to say. I'm particularly proud to be part of this board in that some of the committees, and Peter, you know this, you go on lots of committees, sometimes you don't always feel you're progressing as well as you could or as fast as you'd like to, but particularly on climate change. I mean, we have actually had the Extinction Rebellion into one of our meetings, as I recall, and you know, our first obligation is towards the pension fund and its members, and that is paramount, to make sure, wherever possible, that their investments are dealt with fairly and equitably boosted. However, we do have that moral, and we have a particular conscience there as far as climate change, and I think as a board, we've really done well. The proof is that we are nearly at our limit we set. But I think morally and actually, in actuality, we've pushed on this the agenda quite quickly and quite well. And personally, I'm very happy to be part of the board that did this. I mean, we've done some marvelous things in terms of, you know, the All Wales pension fund, etc. But this is one of the ones I'm particularly proud of. Yeah, as I say, so just to perhaps allay Peter's not fears but concerns that we're not. I think, and I know you said it wasn't a criticism. I take that as great, but you know, I think, you know, to be fair, we need to start patting ourselves on the back at some point to say exactly what we've done. So thanks, Chair.
As a almost impartial advisor, so I'm relatively new to Swansea, so all of this was in place before I came on the scene. So I'm very happy to confirm that of all the arrangements I've seen, yours is the furthest forward in terms of actually having written commitments, the aspiration and the level of aspiration in those commitments, and then the actual action. So I think you are doing very well. To say that we don't see the 50% as a limit or a target as such. The conversations we'll be having with Jeff, some of the ideas we have in there would take that further. So we don't see going below 50 as a problem if there are value-adding investments which would take you in that direction.
Thank you. Are there any other hands up that I've missed? If not, David, you put a slide up showing the increase in active pensioners versus the reduction in equity percentage. I don't know if it's the size of the screen or, as I say, my eyesight. Is there a time scale along that?
No, it's very much a schematic to illustrate the direction of travel, and the angle of the arrow is meant to represent that this will be a more gradual switch, because you're still very much an active scheme with active employees and members. So we're not expecting that to be a huge swing, but as part of each valuation is carried out, we do keep an eye on the growth in the pensioner population relative to the actives and deferreds.
Okay, it may be a question more for our actual. Jeff.
So sorry, Chairman. I just if you can call it on that same day, the ACM, I made a presentation. And if you think of David's slide as maybe a seesaw of when it starts tipping and becoming parallel and going the other way. We project that time will be about 9 years at the latest actuaries projections, i.e. when we start going cash negative, in that we'll have more pensioners than we have active members, etc.
That's 9 years from today, Jeff.
9 years from 2019. Yeah, it's an approximation. It's an approximation.
Yes.
Yeah.
Okay, I wouldn't expect you to give us a specific day. So that's not that far off in terms of our investing strategy. And we're actually reducing our equity percentage now, aren't we? But then, David, I thought you mentioned something about an attempt at market timing. And can you explain a bit more about that?
Not really market timing. I think it would be a brave soul who would call markets the top or bottom at the moment. So that's absolutely not what we are looking to do. The consideration there really is around your funding position, and if it is felt that it is broadly on track and equity markets are at a reasonably good level, that there's a reasonable opportunity there to lock in some of the gains you've seen and protect those in future. So it's not so much a call that markets are going down from here. It's just that you've done a lot of good work. It would be a shame to lose that now. So protecting it where that makes sense in the context of the funding valuation and contributions from employers, etc. So we need to take all of that into account before we move in that direction.
Thank you. Are there any further questions for David? Perhaps, Jeff, then one for you. David mentioned that our protection strategy was leading nationwide, I think, to paraphrase him, or had been recognised nationwide. Has there been any further recognition of that?
Well, it's quite timely, actually, Chairman. You were at committee when it was referenced, I think, weren't you? Yes, the fund's been shortlisted for an award, Local Authority Pension Fund Awards, for that piece of work. It was quite innovative, and I can't lie. Obviously, this was done before David joined the team, but I can't lie and pretend that we foresaw COVID, and it was implemented for that very reason. But yes, we implemented an equity protection program back in 2019 with a view to recognising the long lead-in time of that £200 million deployment that David referred to in the real assets, identifying and buying residential property, identifying and investing into renewable infrastructure. We recognised that would take some time. So we thought, nope, the committee have made a strategic decision to implement that. However, it's going to take some time to do that. So how can we mitigate that lead-in time? And so we determined to implement that equity protection program. And as David indicated, with the market drawdowns in March, it stood us in very good stead at that point in time. It's not designed to make money. It's designed to be market neutral, in effect, just to mitigate and protect us against any adverse movements. But in that instance, it was particularly beneficial. And that bit of innovative work has been recognised in Swansea being nominated for Best Investment Strategy and also Best Investment Innovation Award for 2020. That'll be announced next Wednesday, I understand.
Okay. Well, I'm sure the board would like to congratulate the scheme as a whole. I suppose. The fund as a whole, rather than the scheme as a whole, on that nomination. If it's good news, perhaps you could circulate to board members next week?
Of course.
Thank you. Any further questions for David? Because I think he's going to leave the meeting after this. No. Well, can I thank you very much for your presentation, David, and for dealing with all the questions that were asked of you. Thank you.
You're very welcome, and thank you for the questions. It's good to have some discussion around these points. And
we look forward to seeing you at future meetings.
Thank you, and have a good day.
Thank you. David. Bye.
Bye.
So to go back to the agenda as circulated, I think the next item is the previous minute is agenda item 5. And if you'll excuse me while I swap screens, it's well marked as page 1 in the pack, page 3 out of 129. Shall I go through them first of all for accuracy? And if I can control my mouse here, page 1, page 2, page 3, page 4, into the closed session, page 5. Any points on accuracy? If not, could I have a proposer?
Move, Chair.
Thank you. Any seconder on the accuracy of the minutes? Thank you. I see Rosemary's hand is up. Thank you, Rosemary. Anybody disputing their accuracy or abstaining? No, I see no indications. Thank you very much. So on to matters arising. Are there any that anybody has that aren't covered elsewhere in the agenda? I'm not seeing any indications, but I'm conscious that I've got a lot of glare on my screen at the moment. So if anybody does have any, can you call out, please? I see none. So on to the next item, and that's the audit report. And Jeff, are you going to take this?
Thank you, Chairman. Like the Chairman, if I could ask members of the board if you have any questions during this report to shout out, as I'll have to switch to my screen, which blanks out all your faces, I'm afraid, board members. Yes, thank you, Chairman. The report before you is the report of Audit Wales. As you'll be used to now, they're required to audit on an annual basis the financial statements that we produce in respect of the pension fund's financial transactions, both the financial transactions in dealing with members, but also financial transactions in dealing with other third parties such as investment managers, WPP, etc. And then also to produce a pension fund balance sheet, ostensibly our net asset statement, letting you know at a balance sheet date, i.e. 31st of March, you know, how much we've actually got in the fund to meet our liabilities. That's done on an annual basis. And obviously this year has been fraught with challenges because our financial year end is 31st of March. And that was, as you recognise, at the height of the COVID-19 crisis. So the board would have received in its previous 2 meetings the actual financial statements, the draft financial statements that were presented to Audit Wales for audit. And it would be remiss of me not again to recognise the sterling work and the endeavours of Karen Cobb, who's on the call, and her team in being able to produce those accounts, but not only produce them, but to produce them to original timetable and in accordance with the original audit timetable agreed with Audit Wales, and getting them over the line in terms of clean audit in respect of that. Because I know, for example, a number of pension funds in Wales audits are still outstanding, and their accounts are still outstanding in respect of that. So it's no small achievement in that respect. And before you today, board members, is Audit Wales's audit report, which they presented to Audit Committee earlier this month, which sets out their findings. I'll just replay So some of the points they wanted to raise to committee at that point in time. They audit to a set of guidelines and regulations as required, read their audit body. And annually, they set a materiality limit, i.e. a limit which they determine below which they will not report on. And for the pension fund, they set a materiality limit this year at £19.8 million in that respect for this year's audit. However, some areas of the accounts, they set those limits at slightly lower levels, and you can see those at 0.4 and 5 in the introduction of the report. As you can see, they set out then areas that they were going to look at in terms of the financial statements, the usual areas of financial control, key items on the balance sheet, key transactions in respect of dealings with members, any related party transactions, etc. But also this year, because of the COVID-19 pandemic and the volatility that you heard referenced by David early on, and the uncertainty in the markets, there were certain of items that they looked at in addition because of the COVID-19 crisis. And as indicated by David, the uncertainty and the lockdowns, etc., introduced a degree of uncertainty around the valuation of certain assets. Listed assets, no problem. They're listed on all the recognised stock exchanges. Could be obtained with relative ease in respect of those listed assets. It was in respect of unlisted assets like property and private equity, where there was a bit more trouble in gaining comfort about the valuation of those assets because, for example, property valuations are traditionally undertaken by surveyors going out and surveying property, evaluating dilapidation, evaluating status of the property, and because of lockdown, that ability was compromised. So the auditor wanted to draw readers of the accounts' attention to a couple of clauses that were introduced in respect of our property valuations, and it was the material uncertainty clause that was introduced in respect to some of those valuations, and they just wanted to draw your attention to some uncertainty around the evaluations around our property investments by one of our managers because of their ability to value those assets at that time. As would have been referenced by David earlier on, you can see that although there was volatility at that point in time, you can see the quite healthy and I suppose unexpected bounce back in valuations since that time. So that volatility has subsequently passed as such, but introduced potentially some other risks in terms of overvaluation, perhaps, as you've seen anecdotally and locally. Housing prices shooting up everywhere nationally, and again, the reasons for which can't really be attributed to anything than a bit of a bubble in that regard. But that they felt that was important to draw readers of the accounts' attention to that issue. In the course of their audit, again, during the normal course of audit, they look for any material misstatements, be they corrected or otherwise. And the two items that they deemed fit to report to members are identified in the appendix of the report. Again, I don't want to dismiss them, but they are quite minor in their nature. Again, they're on Exhibit 3, and again, it's a testament to the quality of the accounts that Karen was able to produce. That there are only two of the summary of corrections made. One of them was a presentational issue, really, in that one of the employers was missed out. The Trinity St David's employer line was missed out in respect of their contributions. The total was right. It just wasn't broken down into their specific line item. And then other presentational amendments were made. Typographical amendments and formatting errors, etc. So again, it's a testament to the quality of the accounts that Karen produced. That there were only those two corrections made. Happy to take any questions, Chairman.
Thank you, Jeff. Questions on the audit report? No? Oh, did I hear anyone then? Well, perhaps a comment, Jeff, to echo what you've said, and indeed, I think what the auditor said in speaking to their report previously, a very pleasing report, and congratulations to Karen and her team on their part in producing it.
Thank you, Chair.
Unless there is anything, we can move on to the next item, which is a regular item for the board, the breaches report. And Jeff, I imagine this is you again.
Thank you, Chairman. Yes, yeah, as you just mentioned, Chairman, regular report. They were required to report on the regulatory breaches. And as you can see at the bottom of the appendix, right at the bottom, you can see the new breaches reported since the last time the board had opportunity to consider the breaches. As you can see, very welcomingly, there are no GDPR breaches this time. There are the usual contribution breaches whereby the employers have paid late. However, we subsequently received those contributions, and again, perhaps understandably due to the absence in the from the workplace and the necessity to have actual physical documents to verify marriage, divorce, birth date, death, etc. The ability to process normal retirements is compromised a little bit. However, we do have a rotation of staff at the Guildhall, skeleton staff to handle those admin issues. But understandably, it has been impacted a little bit. However, the breach that you see recognised there is still well within acceptable levels. Happy to take questions, Chairman.
Yes, thank you, Jeff. Any questions on the breaches? I see some shakes of the head. And I see a message coming up. Jeff, just a comment perhaps rather than a question. Now when we're all dealing with documents electronically, is it possible to flag up in some clearer way which are the most recent breaches in the report? I'm finding that little asterisk a bit hard to spot.
Okay. Yeah, quite happy to address reformatting. Quite happy just to report new breaches if you prefer. It was just for completeness of evidence and for readers to see the evolution of the PIs from period to period.
I think what was useful for me when I first saw them was the fact that late payment is a perennial issue for you, late payment of employer contributions. And I know for those new to the board, this is a matter we've had quite a lengthy discussion on about ways of addressing those late contributions, haven't we? Because it does seem to be the same names cropping up again and again. If you were happy to mention that as part of your talking to the report, then for my part, I think all we're really concerned about is the fresh breaches. What do board members think of that suggestion from Jeff?
Yeah, I agree, Chair.
Do we only want to know about fresh breaches, given that we'll have already received previous breaches? I'm wondering, Jeff, if periodically you could produce a report highlighting perhaps recurrent themes, perhaps once every couple of years maybe would suffice, and then only report, but in the meantime only report on fresh breaches.
Quite happy to do that, Chairman. However, we're in accordance with the TPR, the Pensions Regulator, we are required to report the breaches in full to the committee on a regular basis, which we do. But quite happy to annotate and redact certain elements of it to the board as you see fit.
I'm suspecting work-wise, the simplest thing would be for us to get the same report as goes to committee, wouldn't it?
In fact, that is what you get, Chairman. You
Yes.
get exactly the same report as committee gets. So they need legally to receive all breaches, regardless of whether there are occurrences of breaches in previous periods, etc. They are legally required to receive and be reported all breaches that occur during the period.
I'm thinking then that any work obviously has a cost to it. Perhaps they'd welcome greater highlighting of the most recent or the new breaches, and then we could just have the same report as they have for simplicity. Yep,
quite happy to do that. But as you quite rightly point out, Chairman, as your experience indicates, that they are the tried and tested and the usual suspects in terms of types of breach. It's just the only thing that changes are the numbers and slight variations on the reasons why.
Yeah, I mean, one thing that would be a concern is if we were getting repeated GDPR breaches of the same type, of course, which I'm pleased to see we're not. Okay, so I think what we've come down to, unless anybody dissents, is that we'll have the same report as the committee gets, but that the presentation is going to highlight which are the most recent, the new breaches.
Quite
Thanks. Board members, are you happy with that?
Yeah. Oh, you just get you a pair of glasses, Ian.
Yes. Sadly, I don't think it's the optics that's the problem. Maybe the processing matter. Thanks. I'm having particular difficulty today with this screen because I've got the Swansea sun blazing in, which is unusual for November. Moving on. Sorry, was there a comment there? I missed it.
God shines on his favourites, Ian.
What can I say? The next item is 7B, the review of the, it's the pension admin report. Jeff.
Yeah, thank you, Chairman. This report went to committee almost as a reaction, I suppose, and as a response to the legal remedies proposed in respect of McLeod and Sargent legal cases, which the government has lost. Just by way of by way of reminder, this was in respect of a legal case that the government lost in respect of age discrimination in respect of changes to pension rights in the public sector, and those cases were originally brought by members in the fire service scheme and the judges scheme. And I think the appellants were McLeod and Sargent in those cases. Obviously, there was look through across the public sector, and obviously it would impact on the LGPS. And following that judgment, some work has been done by Scheme Advisory Board, MHCLG, our actuaries, etc., to evaluate the impact and additional work that is required to implement those remedies. And this report, in short, is looking to ask for additional resource, temporary additional resource, in which to address the additional work in respect of the McLeod judgment, but also some other ancillary pressures facing the pension administration section. One, which is in train, and I know the chairman is very well up to speed on this. The exit payment cap issue. Again, that if it goes forward, will require additional resource and additional work, and then also some other ongoing work, which again remains unresolved, is the GMP reconciliation work, which is still ongoing. So in the main, this resource ask was in respect of McLeod and Sargent judgments, the additional work ensuing from that. However, the additional resource could be flexed to address these other issues. So in short, the ask was to enhance the pension administration by 4 FTEs, as identified later on in the report, on a temporary basis for 2 years. And as you can see in the comparators there, in 3. Sorry, not in 3. In 5, 5, 5, 5, 6, 5, 7 down, and in 5, 7 in the comparison with the rest of the LGPS in Wales, we can see that even when we resourcing up with those additional 4 members, you know, we're still well within the pack in respect of resourcing in throughout Wales. Noting that we're probably one of the, you know, I think we're about the 3rd largest fund, 3rd or 4th largest fund in Wales. Nothing further to add, Chairman, to that.
Thank you, Jeff. It's an information item for us. Do board members have any questions?
I don't have a question. I don't know, declare an interest here. You mentioned the fire service board scheme. I've actually in the last week or 2 been nominated as a vice chair, you know, and I'm going on to the pension scheme for the fire board to represent South Wales Fire Service, but that's in my councillor role. So just as a point of interest, I know you mentioned it briefly.
Excellent. Well, hopefully, David, you'll be able to bring some information from that role into this role, and vice versa. Congratulations to you.
Cheers, thank you.
Anybody indicating, and I've missed, to ask any questions or make any comments on this? It seems a very sensible response to the increase in workload. Moving on then to exit payments. Jeff, item 7C.
Thank you, Chairman. This report went to committee sort of as a for information report, because it was after the date of the closing of the consultation. However, the consultation was run past the chairs of both the Pension Fund Committee and the chair of the local pension board before it was submitted, and I know the chairman did have the opportunity to have a look and provide comments before it was sent off. The report that you got before you is the proposed response, well, the submitted response of the Swansea Pension Fund Committee in respect of the consultation on exit reform. It's the consultation was about exit reform in general. However, it's inextricably linked to the 95k cap regulation, which came into force as well, because obviously of the natural interaction between those 2 pieces of legislation. And I think a lot of the consultation responses received indicated that you know, it was quite a confused and the timing of the consultations weren't the best, and created and has caused a lot of confusion and uncertainty. Just by way of background, just to remind members of the board, the 95k cap came into being on the 4th of November. As you know, this sought to limit public sector exit payments to 95k cap as a result of redundancy in the public sector. However, that very unhelpfully ignored the fact that in the public sector, the LGPS is singular and separate in that it is the only funded scheme in the public sector. When someone is made redundant, there is the expectation, there is the equivalent pension strain cost that is due from the employer. And although that was made clear to government in the consultation to that piece of legislation, they chose to ignore it, so that LGPS members and public sector members who are members of the LGPS scheme were sort of adversely affected by that piece of regulation as opposed to their other public sector colleagues. So that came into force on November the 4th. However, subsequently, there was this consultation to further exit reform, curtailing looking to again control the costs of the cost of redundancy in the public sector should a member be made redundant, and it was looking for responses to that consultation. However, as I previously said, you can't read both those pieces of legislation in isolation, and what was pervasive between both pieces of legislation was how in the LGPS, how far down the salary grading structure those pieces of legislation start to bite. Obviously, the public perception was that the 95k cap was looking to clip the wings of your high earners, your senior members of the structure who are, not to put it bluntly, being rewarded for failure and being made redundant with six-figure exit payments. That was the public perception of why that piece of legislation was brought into being. However, the way it works, and especially in LGPS, those regulations do start to bite at quite modest levels of the salary scale. So the response that we've submitted highlight and indicate that, and also the report indicates that there is a judicial review pending. I know Steph's colleagues and in the lawyers in local government have submitted a pre-action protocol letter which indicates they're going to submit a judicial review in respect of the proposed exit reforms, and also whilst government are considering a waiver in respect of the 95k cap in Wales in respect of LGPS strain costs. There's an interim solution being put into place. As I say, those regulations are already in force, so they are currently working on interim waiver proposals that can be implemented in the meantime before that waiver is fully implemented. So, Chairman, just the report's before you for information, and hopefully my bit of background there helps with a bit of the understanding and how very much this is a live issue and is still being looked at and evolving as we speak.
Yes, thank you, Jeff. I see David White, you're indicating.
I jumped the gun too early there because I think Jeff went on to cover most of my questions. I was going to say I understand that Welsh Government were challenging this, and they wanted to be more of a local Welsh Government, issue. And again, when Jeff mentioned, initially it was thought the high earners would be affected, but in reality, its outcome, it's going to impact on a lot of people who are maybe middle earners, and that kind of sense, So I think there's a long way to go yet, and I think, as you said, I know the unions have put in a challenge to this, So hopefully, like you said, it hasn't been resolved yet, and that, on a personal level, I know as a unison from the user point of view, I hope Welsh Government can step in, and to me, it's part of your contract. This is part of your contract. The way you leave and your pension, and I think that I think that's got to be negotiated, not just enforced upon us.
Thank you, David. Any other questions, comments?
Chairman, sorry, just to confirm what David White has just indicated. So sorry, David. I thought you had your Bridgend hat on then. That's yes. These exit payments are in respect of when the member is made redundant. It's not a a reward or anything in that regard, or discretionary in that regard. It's as a result of the employee being made redundant, either on a voluntary basis or a compulsory basis. But that's an important distinction to draw out.
Yeah, I was very pleased, speaking personally, to read Swansea's response. Not only does it affect relatively low-paid workers with long and loyal service to the authority, but in comparison to the private sector, which seems to be the government's darling, it affects employers too, because it affects employers' abilities to reduce their headcount through voluntary redundancy, ERVR schemes as well, which is a freedom that the private sector has. It does seem to be ideologically based, which leads us on. Jeff, you indicated that Welsh Government's considering using its devolved powers. Do you have any update? I know lobbying has gone on to Julie James. Do you have any update on that?
All I can say is that they are definitely very positively looking at it, and they are proposing to use their devolved powers to implement a waiver. However, early soundings are that potential waiver may not be a blanket waiver. There may be some caps and collars to it. There may be some degree of capping, maybe in terms of when that waiver will kick in to as you say, only help implement the waiver at the modestly paid levels, rather than the higher earners. That's purely anecdotal, though, Chairman. But what I do know is that they do intend to implement a waiver of some sorts.
Yeah, the issue then, of course, is the uncertainty for both employers and employees until that is implemented in Wales. Is going to be and of course for pension administrators in the meantime until it's resolved.
Correct, Chairman. As indicated, perhaps I didn't make clear, there are working around arrangements whereby I think Welsh Government have set up a sort of a star chamber almost to consider exits which breach the cap, which they can implement there. Because under current regulations, there are instances whereby you can apply for a breach of the cap. However, that needs to be approved by Welsh Government. So they've implemented some sort of interim arrangements whereby, as you say, Chairman, before the waiver comes into being, there is some sort of workaround in the interim. Welsh Government will be considering exits.
Yes. Yeah. Okay.
I think Rosemary's got a question, Chairman.
Okay,
Yeah,
Rosemary.
Yeah, it's not a question. It's a comment just on what Jeff has just said, that the GMB political machine has also had the unofficial nod that the Welsh Government are looking at using their powers to disallow this regulation in Wales. Obviously, that hasn't been officially come out yet, but we're hearing very similar things.
Yes, I think the key point is going to be the precise form of that, isn't it?
It is, yeah.
And in the meantime, as I think we'll all can imagine, the decision to apply for ERVR is a very difficult one for employees to take, and they want accurate information to base that decision on.
Thank you.
Okay, is there anybody else indicating that I've missed? No. Well, thank you, Jeff. And next item on the agenda is the exclusion of the public for the remainder of the meeting. The legal reasons are given at agenda item 8. Does anybody have any questions for Steph or generally on those reasons for going into private?
No.
I'm not seeing any. So could somebody move that we go into private?
Move, Chair.
Thank you.
And our second.
And seconded. So we're going to go into private, which means,
Chair.
Jeremy, I think you're going to cause the recording to stop.